Hi, let's break down the assignment of mortgages and the importance of estoppel certificates. Purchasing property with an existing mortgage. It is common that a property being offered by a seller will have an existing mortgage. Assignment of mortgage. With an assumption of mortgage, the new owner takes title, knowing that there is still a lien on the property. Assignment of mortgage. Assignment of mortgage allows for one borrower to be replaced with a different borrower. The legal instrument that transfers the mortgage and promissory note to the purchaser is called an assignment of mortgage. The first borrower is still responsible for the debt unless a novation agreement has been approved by the lender. Estoppel certificate. An estoppel certificate is issued to verify amounts of any unpaid balance, interest rate, and date to which interest has been paid prior to the assignment. An estoppel certificate is required for an assignment of mortgage. Estoppel certificates are also requested from homeowner associations to verify outstanding amounts owed by the seller or due back to the seller at closing. Title companies or title attorneys usually handle the request for estoppel certificates. Provisions under subject to the mortgage. Purchasing property subject to the existing mortgage retains the seller on the original mortgage of the property. However, property title is transferred to the new buyer as the new owner. Subject to the mortgage means that the seller still holds the original mortgage on the property. This does not make the buyer responsible for the mortgage. If the seller's lender isn't paid, it is only the seller that is responsible for defaulting on the loan. It will not affect the buyer's credit. However, the lender would have the right to foreclose on the property. As such, this type of purchase can be risky for the buyer. It could also be risky for the seller. If the buyer stops paying the agreed upon amount to the seller, if taken in monthly payments, the seller would still be liable for the seller's mortgage payments. and the buyer would have possession of the home. Subject to mortgage. Summary. Transfer title to the new owner. New buyer not responsible for the original debt. The seller is responsible for the original debt. Poses both a risk to the buyer and the seller. Effects of a due on sale clause. Both an assignment of mortgage and the selling of a home subject to a mortgage could cause the original debt of the mortgage to become due in full under the due on sale clause. When a mortgage includes a due on sale clause, it calls the entire loan balance due upon a sale. Because both an assignment of mortgage and the selling of a home subject to a mortgage, such as their land contract, or acts of selling the home, the entire loan balance would be called due. Novation agreement. When lenders do allow for an assignment of mortgage and will also allow for the original party to be relieved of the debt, a novation agreement would be granted from the lender. A novation agreement relieves the original borrower from the debt. The buyer would have to be approved by the seller's lender in order to take over the debt. This means that the buyer would need to meet loan application standards, as would any other buyer. Assignment of mortgage. You might be wondering whether a buyer would want to assume a seller's mortgage, or why a seller would want to sell a property, allowing the buyer to assume an existing mortgage. The main reason for the buyer is to save money on the interest rate charged. The main reason for the seller is to have a marketing advantage, which allows for increased sales price. Let's say that Tommy bought a house in 2019 using a loan with the rate of interest of 3.3%. 20 years later, Tommy still has 10 years left on his mortgage. He owes $280,000 on a house worth $535,000. The going interest rate in 2039 is 6.5%. It would be to the new buyer's advantage to assume Tommy's remaining loan of $280,000 at the 3.3% rate. Tommy would save 3.2% in interest. Over the course of the loan, that could be a significant savings. However, allowing for the loan assumption doesn't mean that Tommy would have to sell his house for just $280,000. Instead, the new buyer would assume Tommy's loan balance of $280,000 and cover the remaining purchase price with a combination of a new mortgage and a down payment. As a matter of fact, because of the savings the buyer would be getting on the decreased interest on the $280,000, Tommy could negotiate to sell the house for more than the $335,000 value. Let's say the new buyer agrees to pay $540,000. The buyer puts down $60,000 and the buyer takes out a new loan of $200,000 to cover the remainder of the purchase. The seller got top asking price for his home, even a little above, and the buyer is paying 6.5% on $200,000 plus only 3.3% on $280,000. As such, the buyer is saving 3.2% on the $280,000 loan, a win-win for both the seller and the buyer. If that whole scenario seems too complicated, you might be tempted to ignore the concept of assumed mortgages. And honestly, when you get started in your career, you will probably be able to, particularly since interest rates are lower than 10 or 20 years ago. You might come across a seller that bought recently at a lower rate than current rates, but it isn't as likely. And probably not as much of a savings to be gained for the buyer with the modest differences in rates. But if rates do climb over the years to come, you will want to circle back to this device of mortgage assumption.